I'm Danielle Hale, Chief Economist at Realtor.com, and here's what you need to know in June. Overall economic activity in the first quarter grew more slowly, but not by as much as initially estimated. Upward revisions to some types of investment, state and local government spending, consumer spending, and exports drove the change. Meanwhile, jobs data painted a mixed picture. While the economy added a surprisingly strong more than 300,000 jobs in May, wage growth cooled and the unemployment rate ticked up. At 3.7%, this is still a very low unemployment rate, but it was a large pickup. At the same time, the number of job openings inched up in April. And meanwhile, jobless claims are still relatively low, but they have climbed above 250,000, the highest level since November 2021. On the whole, workers face a favorable labor market, but there are some modest signs of cooling. Inflation data was similarly mixed. On the positive side, the annual headline CPI receded to its smallest rate in 2 years. But core CPI, which excludes food and energy prices, fell by a smaller amount, and monthly price gains rose for a second month. With mixed economic signals, the Fed chose to keep rates steady in June. At the same time, they sent a very strong signal to markets that tightening is not yet over. Based on their projections, Fed members expect another 1 to 2 quarter-point rate hikes to be appropriate by the end of this year. This could put some very near-term upward pressure on mortgage rates, but ending inflation sooner is going to enable mortgage rates to ease sustainably. Mortgage rates steadied in early May around 6.4%, but climbed in the latter part of the month, reaching nearly 6.8% in early June. As we near the end of the Fed's tightening cycle, we do expect mortgage rates to begin to decline, but there may still be some upticks as the exact endpoint is not yet determined and will depend on the data. May housing data shows that inventory continues to climb relative to 1 year ago as homes sit longer on the market, but the advantage over last year is shrinking, and declines are likely on the horizon. The number of sellers putting new listings up for sale is still lower than prior years. Price growth among the typical home listing was less than 1% in May and is likely to decline in June. Already, weekly data show a mildly negative trend. In a way, listing prices are playing catch-up to sales prices, which dropped again in May. Meanwhile, the number of existing home sales steadied in May after slipping in March and April. Data show that investor buyers are still active, but slightly less so than in 2022 when they bought up a record-high share of homes sold. At the same time, builders have been optimistic, and construction in May picked up for both single and multifamily homes. Less constrained inventory is expected to boost new home sales relative to existing in the months ahead. Realtor.com released the revised housing forecast and outlook in June. Looking ahead, although buyer and seller optimism has wavered, we expect home sales to roughly maintain their current pace through the end of the year. Home prices are expected to soften relative to our earlier projections, and mortgage rate lock-in causes the inventory recovery to stall. But buying costs are still high, and the elevated rate of cross-market home shopping that we've seen recently, driven by the search for affordability, is likely to continue. We also project that national rents will start to ease, furthering the latest trend, which showed a drop in the typical asking rent in May. Despite decline, renters who may not have moved in several years could see their costs increase if they're looking for a new home this year, especially if they're in the Northeast and Midwest, where asking rents are still generally climbing. You'll find all the details along with our housing data for download at Realtor.com/research. You can also follow us on Twitter for real-time updates.